Hi guys, good evening and welcome to Moneycontrol Markets Weekly. I am Karunya Rao. It's been a reasonably good week for the last week. Markets have finally taken a breather and they finally managed to snap that 2 week losing streak. Frontline indices, both Sensex and the Nifty gained about 2% each. You had Auto Index, the biggest outlier as far as sectoral performers are concerned. 39 out of 50 Nifty stocks record gains this week. 12 of them have logged in gains of 5% each. So, not much to complain about. Let's talk about the week gone by and the big trends that are shaping up for future. Let's bring on board our guests on the show, Mr. Trideep Bhattacharya. He's the CIO of equities at Edelweiss AMC. Mr. Bhattacharya, great having you on board. Thank you for joining in.
Good evening, everyone. Thanks for having me on your show.
Well, you're joining us at a time when the markets are looking rather optimistic, rather upbeat. But if we look at the larger trend, it's the liquidity fueled rush which everybody was participating in all of last year and even earlier part of this year. That is clearly run out of steam. So talk to us about what lies ahead for retail investors. What should they expect? Because people who are new to the market have not seen this kind of a volatility and these kind of wild swings ever before in their life.
Yeah, absolutely. I think what lies ahead, if I were to give you first a pointed answer and then elaborate, I would say what lies ahead of us is 3 or 4 months of further volatility, um, and and after that, hopefully, a bit of stability. But let me elaborate on what I mean by that. Basically, since the beginning of this year, I've held this view, and I continue to kind of say the same thing that. The 12 to 15 months starting Jan of 2022 was always supposed to be a bit of a volatile time overall for markets, and that should be seen as a tale of two halves. Where the first half, which is the first 6 to 9 months, and practically better part of 2022, would be basically a time where we would see volatility. In other words, we will
Hmm.
not make money, and that is in a certain extent to a certain extent to be expected, given that we've had a phenomenal year 2021, where just a large cap has given you 21% in dollar terms. Mid and small caps had given you 45 to 55% returns, right? So you would expect a bit of consolidation, a bit of weakness in the markets after that, and that is exactly what is happening right now as we speak, and we have probably a few more months to go. But there are a few changes that are happening in the market as well. Like for instance, I mean, we have been used to the most prominent being actually three of them. We are used to a scenario where interest rates were falling all this while, and finally interest rates have started rising, right? So the market has to adjust to that. When that happens, generally markets first get a little jittery, and then gradually coming to terms with it, which is where we are now. Secondly, supply chain driven inflation is also driving the market a little nervous as to the longevity of this inflation and whatnot. And finally, the geopolitical issues are what they are. So all of these put together, the first 6 to 9 months of the year was always expected to be volatile. So if you really ask me, it doesn't come as a big surprise from where I look at the data. But I think for retail investors, as you said, what lies ahead, if they're able to kind of hold on to their nerves for the next 3 4 months, we think there are better times ahead, because over the next 2 to 3 years, we think the Indian economy is in good stead.
But in the interim, volatility is could be very stressful for first-time investors or for those who are late entrants in the market. Is it an opportunity to perhaps not only learn lots for future investment strategies, but also to lap up some opportunities that the market presents itself with? How should one go about looking for the right kind of assets and even the right kind of stock picking at this point in time? What would be the strategy?
I think it's a great question. Let me complete the viewpoint that I sort of stopped in the middle. So I talked about that the first 6 9 months would be volatile, but if you look further out for the next 2 to 3 years, and look at the Indian economy, for the first time, we are seeing good and decent signs of capex cycle picking up in India, driven by private sector. It is something which has not happened in the last 10 years, so it's new, and but a significant positive, if you really ask me, as a market observer for the last 25 years. Second, for the first time in the last 10 years, we are actually seeing real estate sector bottoming out. The inventories for the first time across, particularly across India, particularly the tier 2, 3, and 4 cities are kind of gradually bottoming out, which hopefully means better times ahead for real estate sector and the allied sector. Real estate sector, mind you, is a big employment generator. And finally in our economy, we are seeing salary hikes coming back in double digits. So all of these actually make me feel positive about equity markets from the 2 to 3 year perspective. And hence, since I'm positive on equity markets from a 2 to 3 year perspective, I would rather use the volatility in the first 9 months of the year or better part of 2022 as in a staggered manner to put money to work. So, in the form of, while lump sum can actually kind of get you on the wrong side of volatility, I think the right way to go about investing in this time frame, is to first go in tranches. It's a sensible decision rather than the right decision. But I think overall, if investors were to kind of take advantage of these volatile times, they would kind of get their portfolios well in tune for the positivity that we might see in the medium term.
In fact, you're talking about using volatile times as an opportunity. I saw several reports wherein you've stated, or rather called 2022 as an investment year. So is this just the volatility that makes you feel like this is a good time to go after the right kind of investment bets, or are there more triggers that you are betting on?
I think basically volatile times means that markets generally takes time to adjust to a few changes, macro changes globally as well as in India. And typically when that happens, the market doesn't run away, and it gives investors a bit of time to kind of take a bit of a breather and understand where exactly the pockets of the so-called pockets of alpha. And if I were to kind of look at pockets of alpha in sync with what I stated earlier, I would say that the private sector investment demand related sectors, also so to speak, the real estate and allied sectors, and finally kind of governments, beneficiaries of government schemes would be key areas that one should look at. The real advantage of these times in markets is it gives a bit of a pause for the stocks to correct, to come back a little, and gives the opportunity for investors to actually get some of these stocks at cheaper prices. I mean, in a runaway
Yeah.
market, it's very difficult to kind of do that. This is the time, trust me, for investors to kind of take a bit of a pause, identify the areas where one can potentially put money to work, and some of them are the areas that I talked about, and gradually put money to work in tranches.
So you did talk about briefly real estate and allied sectors. Any other segments or themes that you like for the longer haul, the 2 to 3 year time frame which you were mentioning?
So I think apart from real estate and allied sectors, I would say that given that my expectation is that we would see a private sector capex cycle comes through, I think industrials is a good place to be, to or rather good place to hunt for fertile ideas. I think for the first time in a decade or so, what we are observing is that the capacity utilization in the private sector is coming to a level where there are fresh investments being envisaged by the private sector companies. And generally during these times, industrials as a sector or capital goods as a sector tend to do well. So that will be another area that I would be hanging on my hat on from a medium term standpoint. Also, I mean, I think I must compliment that the government steps that they have taken in the form of PLI, or for that matter, to the other schemes with regards to domestic defense related orientation, are steps which are steps in the right direction, will make India a self in surplus country, and hence from that perspective, some of these themes could lead to could have some beneficiaries which investors could look at as well. So to answer your question, apart from real estate, industrials would be another one. Defense could be another area to look at. And finally, and very importantly, I think for the first time in a good while, we will see a rebound in credit growth. So some part of financials could be another interesting area to look at as well.
Okay. All right. In fact, I wanted to talk about credit growth because um, RBI clearly looks like it's going to be hiking interest rates in the next few months as well. So, can that mean slow credit growth for banks as well?
Uh, so let me kind of in front of you lay out what the banking sector has gone through for the last few years, where they are, and where to expect in the few in the coming 2 to 3 years, and then in that context answer your question. I think if you look at what Indian banks have gone through over the last 3 to 4 years, is facing the pain of the asset quality go through their financials. So there was an NPA cycle we saw the worst of over the last couple of years, and finally we are coming to the end of it. And we are now in a situation where corporates are delevered. Capacity utilization in the corporate sector is at a decent spot where they're looking to do fresh capex, and banks, given that they are through the NPA cycle, are finally looking to lend. And hence, I would say from the bottom credit growth of about 6, 7 odd percent, the credit growth has rebounded to about 11 to 12%, and that's where we are right now. And your question is that if the interest rates were to go up from here, can they stunt the credit growth? Well, I would say that we are in the initial stages of the pickup in the credit growth cycle, so to speak. Usually, during these stages, the IRR of the projects that getting funded by these loans are far higher than the interest rate increases that have happened so far. What essentially
Right.
that means is that if the IRR is about 18% of the project you are funding, if your cost of capital goes up by about 50 to 75 basis point, you don't really change the outlook on the project, and that's where we are right now. So to answer your question, not right now. I think at the moment credit growth will probably kind of still go up despite the interest rate increase that we have seen, because the interest rate increase has been very marginal. Of course, if we make a
Hmm.
sudden and significant jump in interest rates, that could have a different impact. But as of now, we are not in that shape.
Okay. I want to talk about some more sectors actually. If we look at the metal prices, they were, I mean, on a tear early part of this year, especially spurred by the geopolitical tensions, supply side concerns, etc. But they have fallen a fair bit, about 15-20% across the different metals. They've all cooled off 15-20% from their top. Is it a time or is it a good time to look at metal users, the likes of cap good companies, automobile companies, OEMs, ancillary stocks, etc.? In fact, the markets also were fairly, reactive to the news of metal cool off. The last 2 days, we've seen how auto stocks have rallied. But overall, do you think this is a trend that will sustain the cooling off in metal prices? And should we, rejoice as investors of some of these sectors that I just named?
Absolutely. So the answer is yes to it. And I think the reason why that is the case is a lot of commodity inflation and inflation in general that we have been seeing since the beginning of this year is supply chain driven. Let me elaborate by what I mean. Um, Parts of China are closed. Parts of Europe are closed, given the fact that there is a geopolitical tension going on, and also given that sea travel is a bit limited, the logistics costs of shipping around the goods have kind of tripled during that time frame, and this has led to supply chain shortages in different parts of the world. As that has happened, that has fueled or that had fueled the inflation. Now, what's really happening right now is gradually China is opening up. Geopolitical situation, while it has not completely resolved, is gradually getting better, and people are getting used to the circumstances overall. So the supply chain issues, while not totally resolved, are gradually on the way to getting resolved. That's number one. Secondly, we are now kind of coming through a base which is reasonably high. So inflation is gradually cooling off, and that is the reason why commodity prices are finally coming off. So I would say, to answer your question, commodity prices had gone up a bit too much, driven by supply
Hmm.
related challenges. They are now coming back, and hence some of these gains, or rather some of these falls that we have seen in the commodity prices, it ain't going back to those levels earlier. Of course, never say never, but from where we see right now. So yes, the sectors that you mentioned, I talked about in my comments as well: capital goods, autos, etc., which are financials, which are beneficiaries of following falling
Hmm.
commodity prices, should be clearly looked at from an investment standpoint.
I wanted to also get in your assessment of the IT pack. IT has had a very tough year. And one of our viewers actually is also asking the same question, who's watching us live, asking if it's a good time to invest in IT stocks. A lot of these names, blue chip, heavyweights, the likes of a Wipro, HCL Tech, Infosys, they've all lost in high double digits so far this year. So is this perhaps the bottom, do you think, for IT, and buying could happen right now, or should buying happen right now using this as an opportunity?
I think I would say selectively on net balance, we are
Okay.
in our portfolios underweight IT sector. Particularly a segment of the IT sector which is mid cap IT, has been expensive, and probably the valuation normalization has not yet completely happened. And hence, I was saying that when one is looking to take an exposure within the sector, one has to be selective. However, IT sector is going through right now what pharma sector went through sometime last year, where they had
Okay.
clearly supernormal earnings, driven by the lockdown, and the fact that most of the stuff that were done digitally, and the company's earnings benefited significantly, and they are now gradually normalizing in that context. The added complication that we have right now in the context of the IT sector is basically the thought of US recession or not. Now, while the jury is out whether will see a US recession or not, the fact is we will see at least lowering of growth rates in United States. And given that the IT sector is exposed to United States in a major way, some sort of slowdown in growth rates could be expected. Though the companies are right now not saying that, it might happen that we could see some kind of growth slowdown towards the back half of this year. And if that were to happen, I would say kind of it could hurt the stock price performance for a bit more. Um, but this is a transient concern. These IT services companies are backed by strong cash flows, and I'm sure they will come
Hmm.
back on the other side very strongly. Um, the wait that we will see before they come back could be a little longer. Is the point I'm trying to make in the light of U.S. growth related worries, and also the fact that they've had fairly superlative earnings over the last couple of years.
Mr. Bhattacharya, so far, if we look at the fund flows, they've been fairly steady and stable when it comes to equities. But given the fact that we're looking at weak returns, an uncertain market, unpredictable future, are market participants worried that, this could be dented, the flow into equity markets?
I would say that there are two ways to look at equity markets. One is how the earnings are doing, and second,
Hmm.
how the flows are coming through. Right, between these two, if the earnings stack up quite well, flows usually find their way into the market. Is the way I usually look at these things. To elaborate, for instance, since October, November last year, the amount of money withdrawn by FIIs as a percentage of India's market cap is similar as we saw in 2008. The only difference being that in 2008, the markets corrected almost about 60 to 70%, whereas now we are in the top, in about 10-15% from the top. So the reason why that is the case is because the relative earning story in the context of India has been and continues to be robust. And I would say that if one has to hang their hat on in markets on something, that is what one should focus on. And I would say from a medium term, i.e., 2 to 3 year perspective, the earnings story for India is still looking quite robust. So rather than getting worried on the flows, I would say that as long as earnings story remains robust, flows will
Hmm.
come, whether it is domestic or FIIs or somewhere else. And from my read, from what I see, the earnings, particularly in the areas that I talked about earlier, are likely to remain robust. So I'm not worried about the flows too all too much.
But a lot of sectors are also starting to see earnings downgrades as well from brokerages. Does that alarm you? Does that concern you at all?
No. Yes, the answer is yes. The earnings downgrade are coming through, but the earnings downgrade are on net balance. If you look at in the last quarter earnings reported or reported earnings, the earnings actually on for the market as a whole, or if you look at Nifty 50 as a whole, earnings have been flat. And I would say in the June quarter earnings, we would see the impact of earnings. Maybe there is a bit of an earnings downgrade to come through about 2 to 3%, but that is driven by the transient inflation. So yes, there are earnings downgrade in certain pockets of the market, which particularly the commodity users. But as you yourself said, that the commodity basket has started to correct, the earnings will actually come back over the next 3 to 4 quarters. And markets generally tends to look forward rather than from on a backward looking basis. Hence, I would not be unduly worried about earnings downgrade. But I would also say that the market, it's not all ships will sail high. We need to look for the pockets of earnings upgrade, and those will be in the themes that I mentioned earlier. And as long as those
Hmm.
themes, those stocks are carefully picked, the investors would be just about fine.
Well, that's heartening to know, and I'm sure our viewers will take back a lot from the insights you've shared. We've talked about re-strategizing one's investment during uncertain times, during volatile times. But this is something that I often ask my guests on the show, especially during periods of consolidation, that if you were entering the market today, how would you plan your investments, and what are the kind of asset classes or stocks that you would like to sort of have or own in your portfolio on today's date?
So, first of all, I think one has to admit that equity investment should always be done with basically long-term view in mind, and with a long-term, which is 3 to 5 year view in mind. Uh, if I were to look at the scenario today, I would say that by and large, over the last 10 years, 10 to 15 years, we have been used to a bit of a deflationary scenario. We are now gradually entering into a slightly more inflationary scenario than what we were. And during inflationary conditions, there are two asset classes which generally tend to do well. One is equities, and second is gold. So I would look at my asset allocation carefully. Certainly have equities as part of my dominant investment, and probably add a bit to gold. Now, with regards to equities, which is what I'm kind of an expert on, I would say that I would not go in lump sum, but I would go in tranches. Maybe put an STP to till the end of this year, or maybe for the next 3 4 months, and that's how I would put my money to work.
Well, I hope the viewers are taking note of all this and they will be able to use it effectively in their strategies as well. Mr. Bhattacharya, it was a pleasure chatting with you and hearing you talk about a lot of these sectors and tackling volatility most importantly in times like this. Great to have you once again and hope to see you soon. Guys, thank you so much for tuning in. We'll see you next Friday again and get you more perspective on the markets.
Thank you very much. Thanks for having me on the show. Happy weekend.